Last week, I uploaded a video about Jeremy Grantham, a billionaire hedge fund manager who has built a name for himself identifying bubbles, market peaks and market bottoms and making a huge amount of money out of it. Throughout that video, I explained Grantham's perspective, why he thinks the way he does and his justifications, but a lot of you wanted to know how he plans to invest in order to avoid getting hurt by the bubble that seems to be all-consuming. Well, luckily enough, in that interview, he did exactly that. He explained what his portfolio looks like right now and what he recommends our portfolio should look like as well. So that's what we're going to look at today. We're going to very quickly recap what Grantham's thoughts are before going on to look at where we should be putting our money and why we should be doing that. But first, really quickly, make sure to like this video and subscribe to the channel. We're putting out loads of content constantly just like this that you don't want to miss out on.
This is the most broad, as I said, asset bubble of all time, with 3.5 of the 4 major asset classes clearly in severe bubble territory.
Right.
And thinking that you have no alternative but pick between one of the 4 bubbles is a pretty grim way to view life. I get the argument, so pick a bubble, they'll all go together probably, and you will suffer a lot of pain. And the intellectual content of that argument, that they were all bubbles, so we had to pick the least bad one, will resonate in your head as the market unravels.
Is there any way that these bubbles can kind of, just can self-correct, and so that it's not some sort of an Armageddon scenario? Or what is your scenario?
If you had a dozen to 15 years of flat market with earnings doing okay and rotation within the market, everything would work out fine. And every portfolio manager I almost ever met has felt in market bubbles that could happen. It just never does. The market abhors long sideways movements, as we all know. It either goes up more than you think or down more than you think. You can always hold out hope for an extended sideways movement, but it never seems to arrive.
So there is no alternative. Everything is in a bubble. Where should we put our money? Well, Grantham points out that it's hard, that almost everywhere we look, it does seem like the market is overvalued. And so many people flock to the idea that we should just pick the least worst bubble and hope that that's enough to protect us during the next crash. He also reiterated his point that a crash as the bubble pops is the most likely outcome with the state of the market today. It is possible that the market doesn't pop, that it stagnates for 10 or more years as valuations are caught up by the company's fundamentals. But every time there is a bubble, people make arguments for why a crash isn't necessary, and those people almost always end up being wrong. Now, in times like these, investing in non-market correlated assets can really help put your mind at ease. Luckily, I found a partner for today's video that helps you do just that. It's the only platform that lets you invest in multi-million-dollar paintings without breaking the bank, masterworks.io. Now, we all know that the super wealthy love to invest in art, but you might not know why, and the truth is actually quite simple. Fine art has historically appreciated at 14% a year, compared to the S&P 500's return of 9.5% since 1995. On top of that, the $1.7 trillion held in art is estimated to grow by another $1 trillion over the next 5 years. According to their CEO, the data shows that art appreciation starts to become predictable once a painting crosses the $1 million mark, and their platform allows you to invest in those paintings by world-famous artists like Banksy. For example, I think that this painting by Jean-Michel Basquiat is going to appreciate nicely, so I simply went on masterworks.io, selected the number of shares that I wanted to own, and then bought them. Now that I'm invested in that painting, I can either wait for it to be sold, or if I want access to my money earlier, I can sell my shares through the secondary market to someone else. This really is a brilliant platform that is opening the high-end art market to everyone, but as a result of that, there is a long wait list for those who want to invest. Luckily for you, I've partnered with them on this video to provide you all with a link to let you skip that wait list, which can be found in the description of this video. So where does Grantham recommend we actually put our money? Well, I'll let him tell you himself.
Well, I would look around and ask the question, what is the least bad? And the least bad is emerging markets. It's a little overpriced, absolutely, but it is at one of its 3 points of maximum difference to the S&P 500.
Uh-huh.
And each of the other two examples worked out wonderfully well in favor of emerging markets. Conversely, when emerging markets was at a peak, which it was in 07, it sold at a premium PE to the S&P. You can have very bad things happen, which they did. But emerging markets is relatively very cheap and pretty much close to fair value. And the other thing is value versus growth. Low growth stocks have been pummeled by high growth stocks for the decade ending in 2019. And then in the year 2020, they had the worst year by far ever. So you had the worst decade followed by the worst year. And the ratio of value or low growth to high growth was also at the co-equal highest, widest it had ever been with 1974. And the outcome after 1974 for value was wonderful. So I would look at the intersection of those two ideas. If you could buy the value stocks in the emerging market universe, which after all includes...
Which you can, right?
Which you can, and it includes some very high growth potential countries like China, and collectively they will have a higher growth rate than the developed world, almost certainly, and they sell at a huge discount. I would say they are modestly cheap in an S&P world that is extremely overpriced. And you could lock them away for 10 years or 20 years and really expect a decent return, which I would recommend. And since there is no hope of persuading people to actually get out of stocks, that would be the best I could offer. But for those 3 people out there who have a will of steel, I would say also have a cash reserve of 20 or 30%, as much as you can psychologically bear, to take advantage of much cheaper prices sometime in the not too distant future.
So would that be your one investment for a long-term diversified portfolio at this particular point, is to have a stash of cash?
No, I would have low growth emerging markets as much as I could stand.
All right.
And a cash reserve as much as I could stand. And if you had 70-30, 30 cash and 70% cheap emerging markets, that would be a pretty resilient portfolio, I have no doubt. For the next 10 or 20 years, though, I think the S&P, of course, will underperform, just as it had a tough time from 2000 to 2010, where it had a negative return. And emerging markets, incidentally, beat it by 11 or 12% a year compound.
So Grantham thinks that emerging markets and value stocks are both undervalued, or at least not stupidly overvalued, and it's easy to see why. If a company operates a pretty normal business in a market that grows at 2 or 3% a year, then it's reasonable to assume that the business will be able to grow its revenues, profits, and customer base by the same amount without too much trouble. If, however, that market is growing at 8% a year, then even a poorly run business is going to be growing at a pretty substantial rate. And that's where Grantham thinks the sweet spot is right now. Not poorly run businesses in emerging markets, but value stocks. Companies that return decent profits and don't have PEs of 30 or above, that are also able to grow substantially because of the markets they work in. Think of insurance companies, energy providers, or banks in places like Indonesia, India, or Vietnam. Now this strikes me as very similar to the apparent philosophy of Mohnish Pabrai, often likened to as the Indian Warren Buffett. He's made waves over the last few years as he seems to be making the same kind of plays that Buffett makes, with similar sort of returns. We're talking in the realm of 20 or 25% a year with pretty good consistency. He buys solid companies at good prices, but he does so mostly in India, a market that is practically exploding right now. So he gets the benefit of buying at an appropriate price while not having to sacrifice on growth in the future. This is kind of the best of both worlds. You can get the returns that we so often see promised on companies like Tesla or Coinbase, but without the pretty huge levels of risk that come with a company that has to innovate and change an entire industry. Now, all of this does have an asterisk or a caveat to it, and that relates to the portion of your portfolio that is liquid. Grantham made it clear that you should pretty much keep as much of your portfolio as liquid as possible so that you can capitalize on a crash when it happens. But he also recognizes that it's pretty difficult to completely divest from the markets. I know that myself as well. I believe that stocks are overvalued and that a crash, or at the very least a correction, is very likely within the next 18 months to a year, and yet I'm still mostly invested. A 70-30 split between emerging markets and cash seems like an appropriate target, and I doubt many people are going to be brave enough to pull much more than 30% of their portfolio out of the market when bonds and other cash equivalents are just so weak. So what is Grantham actually doing with his portfolio? Well, it's 30% in cash and other liquid assets, but the other 70% is in venture capital. Really early business ventures that have very high levels of failure, but also the potential to do incredibly well like we saw with QuantumScape. Unfortunately, venture capital isn't available to most of us, and even if it was, it's probably far outside our risk tolerances. Personally, my portfolio is about 40% income generating real estate, 40% equities, which is split between emerging markets and the S&P 500, and then 10% cash and 10% in crypto. While I'm not actively divesting from the markets, I am increasing my cash position every week by just not buying in with the money I earn. Now, I'm sure that many of you will be wondering why I'm invested in emerging markets when I'm so against investing in China, and the answer is pretty simple. Yes, most emerging markets funds are heavily invested in China, usually anywhere between 30 and 50%, but the ETF that I chose is called EMXC, or Emerging Markets Excluding China. I get to allocate a portion of my wealth to some of the fastest growing markets in the world, without taking the risk of investing in China and without compromising my integrity. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. Also, make sure to check out this video's sponsor, masterworks.io. Down below, there's a link to my favorite brokerage called eToro, where you can trade stocks and shares, crypto, commodities, foreign currencies, and more, all for 0% commission. There's also a link in the description to BlockFi, where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold. Whether it's Bitcoin, Ether, or stablecoins, you can earn as much as 14% interest a year. I have also started up a second channel, which is going to be more focused on macroeconomics, the housing market, and big ticket stuff like that. It's called Stoic Finance 2, and I've just set up a crypto channel as well called Stoic Crypto, so make sure to check both of those out. Finally, I am working on setting up my own website and my Patreon, where I'll post videos and articles in the future. Thanks for watching. Thanks for all the support. Until next time.